Imagine running a business blindfolded. You're buying goods, selling items, paying salaries, but you have no idea how much profit you're making or whether you can pay rent next month. That's what a world without accounting would look like: chaos, confusion, and zero clarity. Welcome to our exploration of the meaning of accounting. This is your first step into the powerful world where numbers become stories, and those stories help businesses survive and grow. Accounting is as old as civilization itself. From Babylon to India, people have kept records of taxes, trade, and treasure. But modern definitions evolved with changing needs. In 1941, the ICPA defined accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money transactions and events of financial character, and interpreting the results. As economies grew more complex, in 1966 the AI called accounting a process of identifying, measuring, and communicating economic information to help users make informed decisions. So, what is accounting today? Accounting is the process of identifying, measuring, recording, and communicating financial information about economic events to the people who need it most. It's not just record keeping, it's about telling the financial story of an organization with numbers that speak. To understand this better, let's break it down into 4 key ideas. 1. Economic events. 2. Identification, measurement, recording, and communication. 3. Organization. 4. Users of information. Each of these helps us see what accounting does and for whom. An economic event is something that affects a business financially and can be measured in money. Buying a machine, paying rent, or selling goods all are economic events. These can be external events like selling to customers or paying suppliers. Internal events like transferring raw material from storage to the factory or paying employees. Accounting identifies and captures all financial transactions connected to such events. The entire accounting process works in 4 steps. 1. Identification, which events should be recorded. For example, a change in management may be important, but unless it involves money, it's not recorded. 2. Measurement, events are converted into rupees and paise. If it can't be measured in money, it's not in the accounts. 3. Recording, the measured transactions are written down in chronological order in the accounting books. 4. Communication, reports like profit and loss accounts or balance sheets are prepared and shared with users. The word organization in accounting refers to any economic entity, whether it's a shop, a charity, a large corporation, or a municipal board. If money flows in and out, it needs accounting. The users of accounting information fall into 2 groups: internal users like CEOs, finance heads, managers. They use data for planning, budgeting, and decision-making. External users like investors, banks, government bodies, trade unions, and customers. They want to know, is this business stable, profitable, trustworthy? Accounting helps them answer those questions. Think of accounting like a doctor's health report, but for businesses. Just like doctors check your heartbeat, blood pressure, and sugar levels to assess your health, accountants look at income, expenses, assets, and liabilities to diagnose a business's financial condition. So, the next time someone says accounting is just maths, correct them. It's the language of business, a powerful tool for decision making. In our next segment, we'll explore how accounting acts as a source of information and why it's critical for a growing economy.